Enron's rise was legendary. Its fall was historic. And at the heart of both was the same force: belief. Belief that the executives were geniuses, belief that the profits were real, belief that risk could be hidden forever. But belief is fragile, and when it breaks, even the smartest men in the room can't escape gravity. Before Enron became a scandal, it was a miracle. In the late 1980s, America was rewriting the rules of business. Deregulation, globalization, and new financial engineering promised a future powered not by factories, but by ideas. And standing at the center of this revolution was a man named Jeffrey Skilling. Confident, brilliant, almost evangelical, Skilling believed he could reinvent capitalism. He looked at the energy industry, slow, physical, heavy, and saw something no one else did: a market waiting to be digitized. Enron didn't need to own pipelines. It didn't need to drill oil. It didn't need to produce anything at all. All it needed was information and the ability to buy and sell the future. To Wall Street, it felt like prophecy. A traditional energy company transforming itself into a Silicon Valley-style trading empire long before the world understood what that meant. And behind Skilling was the man who made Enron possible: Kenneth Lay. Charming, politically connected, the perfect bridge between Washington and Wall Street. Together, they built a story so powerful that analysts didn't question it. They repeated it. Enron wasn't just an energy company, it was the future of the American economy. For years, everything Skilling touched seemed to turn into profit. And every quarter, like clockwork, Enron reported numbers that defied gravity. High growth, high margins, no volatility, no downturns. It didn't matter what the market did. Enron always won. Analysts were stunned. Investors were hypnotized. Other CEOs were desperate to replicate it. Behind closed doors, even competitors admitted it. We don't understand Enron, but we don't want to bet against them. In finance, belief is oxygen. And Enron had all of it. But there was a problem. A thin, fragile secret buried deep inside the numbers. None of it was real. And the only thing keeping the illusion alive was the belief that these men were smarter than everyone else. That belief would become Enron's greatest asset, and eventually its greatest weakness. Every empire of deception begins with a simple idea. Enron's was called mark-to-market accounting. On paper, it sounded brilliant. A company could record profits on the day it signed a deal, based not on what the deal made, but on what it might make in the next 10 or 20 years. A pipeline not yet built, count the future revenue today. A contract that might pay off someday, report it as guaranteed income. A business model with no cash flow, no problem. Project won. Wall Street didn't just accept it, they applauded it. Because mark-to-market did something magical. It turned imagination into income, forecasts into profits, hope into shareholder value. For Skilling, it was perfect. It allowed Enron to grow instantly into the world's most admired company, without ever delivering real results. But this system had a flaw, a fatal one. If Enron didn't hit those imagined profits, it needed a place to hide the losses. Enter Andy Fastow. Calm, highly intelligent, and willing to dance on the edge of legality, Fastow engineered a labyrinth of off-balance sheet entities, companies that existed not to compete, but to conceal. Losses disappeared, debts vanished, risk evaporated. Enron looked unstoppable because all its failures had been buried in financial shadows no analyst could see. Wall Street believed the numbers because the numbers looked perfect. Rating agencies believed the story because executives told it confidently. Investors believed the illusion because the stock kept rising. Enron had mastered a powerful truth of finance. If people want to believe something, you don't need to lie. You just need to avoid the truth. But the illusion was fragile, and all it would take was a single crack. A question asked at the wrong moment, a number that didn't add up, a journalist who pulled the wrong thread. Enron wasn't built to withstand questions. It was built to prevent them. And when the world finally looked closely, the smartest guys in the room had nowhere left to hide. In every collapse, there is a moment when the story stops matching the numbers. For Enron, that moment began quietly, not with a scandal, not with a leak, but with a question, asked by someone no one expected, a journalist. Bethany McLean of Fortune magazine looked at Enron's financial statements and saw something strange: huge revenues, tiny cash flow, impossibly consistent profit growth, and a business model that seemed to be everything and nothing at the same time. So she asked Skilling the simplest question in modern financial history: how exactly does Enron make its money? It was a question Skilling couldn't answer, because the real answer was this: it didn't. Instead, he snapped. He insulted her, dismissed her, blamed her intelligence, but to analysts watching, his reaction was revealing, because powerful companies don't panic at simple questions. Only fragile ones do. Meanwhile, inside Enron, panic was growing. Employee stock options were underwater. Trading desks were losing money. Fastow's off-balance sheet structures were collapsing under their own weight. Executives began quietly selling their shares. But to the public, the company said nothing. Belief held the stock up, and belief had to be protected. But then came the next crack. Enron's broadband division, once hyped as the future, turned out to be a black hole of losses. Then another crack. Energy trading revenue wasn't matching market conditions. Then another. Fasto's shadow companies weren't just hiding losses. They were profiting from Enron itself. The smartest guys in the room were paying themselves to hide their own mistakes, and the system was reaching its limit. Skilling abruptly resigned as CEO. Lay returned to calm the markets. But the illusion was already flickering. Inside the company, employees whispered the truth that investors couldn't see yet. If anyone ever opens the books, we're done. And someone was about to. Enron's collapse didn't begin with a bankruptcy filing. It began with a sentence, spoken by the company's own CFO. After weeks of pressure, Andy Fasto revealed to investigators that billions of dollars were missing. The off-balance sheet entities weren't tools of financial engineering. They were escape routes, designed to hide debt and inflate profits for years. When the truth reached the market, belief evaporated instantly. Enron's stock didn't decline. It fell like a building in free fall, from $90 to $40 to $10 to pennies. Not in years, not even in months, in weeks. Analysts who once praised the company reversed their ratings overnight. Credit agencies, asleep for years, downgraded Enron to junk. Banks began calling their loans. Trading partners demanded collateral. Counterparties closed their doors. And with each phone call, the illusion cracked louder. When trust disappears, money follows. When money disappears, power collapses. Employees watched in horror as their life savings evaporated. 401ks filled entirely with Enron stock wiped out in days. Executives cashed out millions. Workers lost everything. Then came the final blow. On December 2nd, 2001, Enron, once the seventh largest company in America, filed for bankruptcy. The building emptied. The sign came down. The empire vanished. What remained wasn't just a corporate failure. It was a collapse of belief, a reminder that even the biggest giants stand on foundations made of trust and trust alone. In the end, Enron didn't fall because the math failed. It fell because the illusion did. Because numbers can be manipulated, charts can be engineered, narratives can be sold. But once trust breaks, no company, no matter how brilliant, can escape the gravity that follows. Enron wasn't destroyed by fraud. It was destroyed by the moment the world stopped believing the story. When Enron fell, it didn't die alone. It took something far more valuable with it. Trust, in markets, in companies, and in the idea that numbers tell the truth. In the months after Enron's collapse, Wall Street went searching for monsters. And it didn't have to look far. WorldCom crashed, Tyco imploded. Arthur Andersen, one of the world's most powerful accounting firms, collapsed entirely, taking 28,000 jobs with it. For the first time in decades, America realized something frightening. If the smartest guys in the room could fake growth, fake profits, fake value, who else was doing it? Politicians responded with Sarbanes-Oxley, a sweeping law meant to force transparency. Hundreds of companies restated earnings. Billions in hidden losses surfaced. But the damage was deeper. Something fundamental had cracked. Because Enron exposed a truth that the financial world had been whispering for years. Markets don't run on numbers. They run on trust. And trust is easier to lose than money. Employees began to question their companies. Investors questioned earnings. Analysts questioned the models they once worshipped. And inside boardrooms, a chilling realization spread. Enron didn't collapse because it was unique. It collapsed because it was first. Because the same incentives to hide risk, exaggerate results, engineer illusions exist everywhere. Enron wasn't an anomaly. It was a warning. A preview of what happens when belief becomes a currency and confidence inflates faster than cash. The world learned that lesson again in 2008 when leverage buried Wall Street. Again in China with Evergrande's hidden debts. Again in 2022 when crypto giants melted down overnight. Every collapse had different numbers, different faces, different excuses. But the same underlying mechanism. People believed the story until they didn't. And the moment belief broke, everything built on it fell with incredible speed. Enron wasn't the end of the story, it was the beginning. A blueprint for how trust collapses. Quietly, invisibly, then all at once. A reminder that companies, like nations, live or die not on profits, but on confidence. Because once belief evaporates, numbers can't save you. Regulations can't save you. Not even size can save you. The world's biggest giants fall the same way. With a whisper, then a crash. And Enron showed us the pattern. The same pattern we now see in stock markets inflated by cheap credit, in debt that can never be repaid, in economies that grow only on promises, in companies valued not by cash, but by narratives. The illusion always lasts longer than it should. The collapse always arrives faster than expected. And Enron was only the first domino in a much larger chain. Because if a single company could rise on confidence and die when trust vanished, What happens when that illusion belongs to an entire financial system? That's where the story goes next.